Welcome to CashOps. Today, we're diving into some intriguing alternatives to the S&P 500. These options aren't just any investments, they're specifically chosen ETFs known for their impressive performance over time. If you're aiming to enhance your financial growth, stick around as we explore these lucrative choices. First up, let's look at the iShares S&P 500 Information Technology Sector ETF, known simply by its ticker, IIT. This isn't your average S&P 500 fare. Instead, it zooms in on the top 65 tech giants. Imagine this. While the broader market grows at its steady pace, IIT has skyrocketed with a 5-year annualized return of 26.24%. That's a serious edge for tech-savvy investors. To put this into perspective, consider a hypothetical investment. Investing $1,000 in IIT without adding more could grow to over $3,200 in 10 years, assuming similar past performance continues, a stark contrast to the same amount invested in a typical S&P 500 ETF, which might only reach about $1,270. Remember, past performance doesn't guarantee future results, but it's a useful gauge for potential. Enjoying the insights so far? Don't forget to hit that subscribe button if you're looking for ways to make your money work harder for you. Now, let's delve into the fees and risks. IIT charges a modest 0.15% fee, significantly lower than many competitors. However, it also sports a higher standard deviation of 18.71%, signaling greater volatility. Thus, while the rewards can be higher, it's crucial to consider the increased risk. Moving on, the Invesco QQQ Trust Series 1, ticker EQQQ, offers exposure to the NASDAQ 100. It's a tech-heavy ETF with a slightly different flavor. Over the last 5 years, EQQQ has delivered a robust annualized return of 22.53% with a fee of 0.3%. If tech is your sector, EQQQ might be your game, especially considering its broad base of 101 equities. Next, let's consider a socially responsible option, the UBS S&P 500 ESG ETF. This fund applies environmental, social, and governance criteria to the S&P 500, filtering stocks to those that adhere to principled business practices. Not only does this meet a moral criterion, but it's also financially sound. Over the past 5 years, it has outpaced the standard S&P 500 with a return of 17.09%. The last ETF we're covering today is the iShares MSCI USAS ETF, which focuses on sustainability. With a unique portfolio that excludes some of the typical top players like Apple and Nvidia, it opts instead for companies like Home Depot and Tesla. This ETF has a 5-year return of 16.38% and charges a fee of 0.2%. Its lower standard deviation of 13.35 compared to the broader market suggests a less volatile investment without sacrificing returns. Let's dig deeper into these specialized ETFs, exploring why they might be the pivotal pieces your investment portfolio is missing. Why consider ETFs over individual stocks? It's crucial to understand the appeal of ETFs. Unlike picking individual stocks, investing in an ETF allows you to buy a basket of stocks. This spreads out risk across multiple companies, making your investment more resilient to the volatility of single stock performances. This diversification is key in a strategy that aims for steady, long-term growth. Understanding the technology-driven IIT ETF. We've touched on the iShares S&P 500 Information Technology Sector ETF, but let's dive into what makes it tick. The tech sector is renowned for its rapid growth and innovation. Companies like Microsoft, Apple, and Nvidia, which are major holdings in this ETF, are at the forefront of technological advancements from AI to cloud computing and beyond. Investing in IIT means you're banking on the continued expansion and integration of technology in every facet of life. Yet with great potential comes increased volatility, which we see in its higher standard deviation. The global tech landscape and EQQQ, moving on to the Invesco QQQ Trust Series 1. This ETF is not limited to the US alone. It represents a slice of the top tech performers globally, providing a broader scope compared to IIT. It's particularly appealing for those looking to tap into the tech boom without limiting themselves to American companies. The slightly higher fees reflect the broader exposure and potential for tapping into international markets, which could yield significant growth as global tech industries expand. The Ethical Investment Choice UBS SP 500 ESG ETF. Ethical investing isn't just a niche, it's becoming a cornerstone of many investment strategies. The UBS S&P 500 ESG ETF offers investors a way to align their financial goals with their values. Companies included in this ETF are scrutinized for their practices in sustainability, social responsibility, and corporate governance. This filtering process aims to ensure that the investments contribute to a positive societal impact. Beyond the feel-good factor, there's compelling evidence that companies prioritizing ESG criteria often perform well financially, showing resilience and potential for long-term growth. Sustainability in focus. The iShares MSCI USA S ETF. The trend towards sustainable investing is more than just a passing fad. It reflects a shift in how companies are evaluated. The iShares MSCI USA S ETF selects companies based on sustainability criteria, focusing on long-term viability and ethical practices. This approach can attract investors who are not only looking to grow their wealth, but also to support companies that prioritize sustainable practices. With companies like Tesla leading the charge in renewable energy and sustainable practices, this ETF is poised to benefit from the green revolution. How to choose the right ETF for your portfolio. Deciding on the right ETF involves assessing your financial goals, risk tolerance, and investment timeline. Consider how these ETFs fit into your broader investment strategy. Are you looking for high-growth potential with tech ETFs like IIT and EQQQ, or are you leaning towards ethical and sustainable investments with the UBS S&P 500 ESG and iShares MSCI USA S ETFs? Investment strategies for different risk appetites. Each investor's risk appetite is different. If you prefer a conservative approach, you might lean towards ETFs with lower standard deviations and more stable sectors. If you're on the adventurous side, the higher volatility of tech-focused ETFs might be more appealing, offering the possibility of higher returns. As we wrap up, it's clear that there's a world beyond the standard S&P 500 that could potentially offer higher returns and meet specific investment criteria, whether it's tech focus, ethical considerations, or sustainability. Thank you for joining us on CashOps. If this video provided you with new insights and helped you think differently about your investment strategies, please give us a like and consider subscribing for more financial wisdom. We're here to help you navigate the complexities of the market with ease and confidence. See you in the next video.